Okay, welcome everyone. We'll start lesson 2. Today lesson will go through LO2, be able to prepare company financial statements. So today lesson will be focused about the financial statement adjustments, end of year adjustment, and how we can prepare these. So that's all. Most of you really preparing these statements. You already know about. Yes, so we'll discuss generic end of year adjustments as well. So let's recap what we learned during our previous lesson. Previous lesson we discussed about sole trader partnership, limited company, charities. We discussed IS. We discussed IFRS. We discussed how many types of statement we prepare, statement of change in equity. We discussed statement of comprehensive income, statement of financial position, and statement of cash flow. So these are the statements normally we prepare in accounts. So today lesson will look around three key statements: statement of comprehensive income, statement of financial position, and statement of cash flow. Okay, so what do you think? 1 to 10 scale. Limited companies and financial statement we preparing? Yes.
Yes.
Do we know how much turnover we can prepare statement if you're not chartered accountant?
I think six point something.
Yes, or 50 or less than 50 implies. Okay, so it's no audit requirement basically. Preparation
Yeah.
of the financial reporting statement for limited company, main elements, private limited company, income statement, statement of financial position, public limited companies annual reports we can as well, generate the corporate information, accounting policies we can. Of course, we can give in notes, what sort of policies we have as a company. We can prepare the statement of cash flows, how many director we have. We can even give the report about the CSR, corporate governance report within our financial statements as well. So end of period adjustment can be valuation of inventory, like under IES2 inventory evaluation. So under IES2 inventory should be recorded either the cost or net realizable value, whichever is the lower. Depreciation of non-current asset, that's your non-current asset register adjustment. That's carry on coming, and of course, you deal these, in financial statements as well. Your schedule about the depreciation, the real value of the assets, yes, and different policies as a company we can. Irrecoverable debt, yes, bad debts, which we can write off. All, we need to make adjustment in our receivables, accrual and prepayment. So that's we need to be proportion. Accrual basis concept, which is underlying principles, exemption in a financial statement. Match is also known as a matching concept. Each year income and expenses should be recorded in the year, not in the following year. We don't record on the basis of the cash. We record basis of the matching concept. So identification of errors, we'll go through different types of errors, how we can make adjustments, how we can correct, in the suspense account, which is known as a temporary account, which won't go in the financial statement, but we can use it to make the adjustment. Okay. Then statement of revised profit we can after any adjustments, and all these the concept will be explained. So that's the key focus in our today discussion. So 2.1 we have a prepare the financial statement, incorporate relevant adjustment for specific limited company. So what is meant by limited company? It's mean the limited liability.
Yeah.
So maybe owned by different people. Limited company is owned by the shareholders, and the shareholder appoint the director, especially in public limited company in AGM, and then of course the director look after the companies. Company Act we already know, 2006 we follow. Accounts of limited companies look like, can be like revenue, cost of sales, gross profit, expenses we can put in two major heading, admin and distribution under IES1, international accounting. Then we can put it finance cost and then taxation, and then profit, net profit after tax, from operation. Then discontinuous operation can be the operation which we sold it, that we can include. Okay, the statement of financial position, of course, it shows asset, liabilities, and equities, whole accounting equation. And this is the pro forma can we use, and then this is the pro forma for financial position we can use. Okay, so this is all about. Then we have a conceptual framework and the principle, underlying principle, what those are. In financial statement, there should be a quality of relevant and the faithful represent. So is the capable making the difference decision include all the material figures. Faithful, those should be neutral, complete, and free from error information contained in the financial statement. They enhance and help to increase the trust. These are the characteristics which we can use: comparability, verifiability, timeline, and understandability. These are called qualitative characteristics about financial statement, and those are the crucial which we can. Okay, notes of the financial statements with required by IFRS or other accounting policy. The note about the financial we can disclose, like what policies we have, a depreciation policies, what other policies we have, a revaluation policies, or what basis we did, or how we recognize the assets and the liabilities in the financial statement. IS 6, which is about, IS 16, which is about the property, plant, equipment, and the depreciation, revaluation, fair value, and economics value. We all know what is the fair value. We know economics value. We know value in use. We know carrying value. And we know cost value. Yes? Which value we should record our assets? So normally we look, maybe we recording at the cost value, but the economics value is a lower. Yes, so we can change it, our value, to the economics value. So we can look around the economic value and the fair value, which is market value. So whichever is a higher, we can record the asset accordingly. So under IS. Okay, so inventory value, always lower the cost or net realizable value. Whichever is the lower, so we should record the lower value, not higher value. Okay, ISB is International Accounting Standard Board. Accounting equations, we know is assets equal to equity plus liabilities, or asset minus liability, net asset equal to. So historical cost, current cost, realizable value, and the present value, that's all term we'll carry on using, and we use in ISs. Okay, the measurement after the recognition cost model. Cost model is what cost you can measure as and you can look around we can include in the asset or not. Revaluation is according to the market value, fair value in normally market value. So we can revalue our asset and we can put revaluation gain as well. Okay, so depreciation, yes, we can. Different bases, we can look around our own policy as well. Straight line, disposal of asset, which we need to. Okay, then to make our statements, which is 2.1, we need to prepare financial statement. I'm going to upload the handout for you, which is, so we can look around good few questions in this handout. You want to include the example when you prepare your assignment, so you can use it. So 2.8, this is the statement, prepare the financial statements, and you will see there end of year adjustments, and this handout we can use it to prepare, and I'll send you the answers for these handouts as well. So that's, we can use example. You want me to go through, or you're okay? Yeah?
Yeah, it's okay.
Yes, so these are adjustments like, allowances for doubtful debt increase. So we need to increase the allowance for doubtful debts, and in the past we underestimate. So it means our expense will be increased, and we need to be minus from our trade receivables. Inventories, of course, closing inventory goes in cost of sales, part of cost of sales, and the closing inventory also are asset. Property, plant, equipment, depreciate, yes. So we need to look around 20% per annum straight line, so we need to be use 20%. So corporation tax we've been given, so that's, and then we can prepare both statement, profit and loss, and this is the trial balance we have, so which we can use. Okay, so that's, I can show you answers for this. So 2.8, we're looking the question about, you can look around other question which is normal adjustment. So this is the full-fledged question. 2.8. Okay, so you will see here 2.8. So you will see the, yes, revenue, cost of sales. Do we know cost of sales formula? Opening inventory plus purchases minus closing. So is
Yeah.
cost of sales. We have a gross profit, admin, distribution. So all expenses we allocate it to both categories. We need to look around which is relevant to. Finance cost is interest, and then we have a taxation. Yes, we can show our workings, and then our balance sheet, non-current asset, current asset with all adjustment, please.
I have one question, sorry.
Sure.
The bad debts.
Yes.
Yeah, bad debts are the expenses. We can put in the profit and loss account, but why adjust in balance sheet?
Okay, so bad debts is expense, yes.
Yeah. I can put in
So
profit and loss account, that's fine.
bad debts will reduce our receivables, yes.
Okay.
So we reduce our receivables. So we do credit to reduce our asset because the trade receivable are asset, and we do debit in the profit and loss because debit mean is expense, yes.
Yeah.
So that's, irrecoverable is mean 100% those happen.
Mm-hmm.
Allowance it can or can't, yes, but still
Yeah.
we can put it in the as expense. But
Okay.
if in the future we have less bad debts happen, yes, written off less, then we can make adjustment in the profit and loss. So these are, we'll see here the bad debts. Yes, here is the increase, yes, because
Yeah.
we already had bad debts in the past, but we
Yeah.
have a further
Mm-hmm.
20,000.
Yeah.
So it can be policy we can charge to admin, or maybe we can charge to distribution.
Yeah.
So that's, and the depreciation we can. And that's all the overall figures. We put it in the profit and loss. Is it clear?
Yeah. So thank you.
Okay, welcome. Okay, next, if you want to do these, little tests, I'm right
Yeah.
and wrong. So that's quite good. And you can go through these, yes, so you can pick it, I'm right and wrong. At the end, we'll show the answer as well. So I copied the link. which also help us to boost our understanding. Okay, next now we have our second 2.2, prepare the statement of cash flow. Statement of cash flow summarize all the movement of the cash during the accounting period. They provide the financial statement with the information about the entity ability to generate cash and cash equivalents. Yeah. So that's,
Yeah.
the inflow and outflow. Uh, Cash flow we prepare under IAS 7, International Accounting Standard 7, which is three activities. Okay, so indirect method recognize the profit before tax to the net cash from operating activity, and most of entity use this method. Direct method is list and actual cash flow. So investing activities and then financing activities. We have where we can recognize the cash. So this is, the cash flow pro forma. We can start profit before tax, and we can adjustment finance cost. We can add it back, depreciation, dividend, yes, gain on disposal, increase, decrease in, and we can prepare. Okay, net cash from operating activities. Then we can do the financing activities and so on. So we can make it. Integrating the cash flows, we can evaluate the needs and identify the correct omissions, errors. If we have, previously, we can look around the bad debts, the recoverable, doubtful debts, so we can make adjustment entry. We can look around accrual and prepayment adjustments. Yes. So if it's an accrual expense, is a liability. Expense will be debit. Accrual mean the expense incurred, but we not paid it.
Yeah.
And accrued income, we provide the service, but we didn't receive it.
Yeah.
So opposite of. So that's, little sometimes can be a confusion. So prepaid expense mean advance.
Advance. Yeah.
So it mean the expense not related this period, that should be related to the next period. So
Yeah.
our expense which we recorded initially should be reduced. So to decrease expense, we do credit what we record initially as a debit, and we do debit as a prepaid. Prepaid is an asset which goes under the current asset in the statement of financial position. But what about the prepaid income? Prepaid income mean advance income we received, we not provide the service. So prepaid income will be on the credit, which is a liability. Yes, like in the
Yeah.
construction contract, we record is the income because we receive a cash, but we not build the house. It's not an income, so we should put as a liability then. Yes, and we decrease our income what we recorded first place, because income goes credit normally. When we need to reduce it, we'll put debit. And the liability as a prepaid income will put on the credit side. Yes, so our liability will increase. Okay, so it's a crucial when you deal with accrual and prepayment, draw the timeline. When my accounting period start, when my accounting period finish. That will help us to determine how much accrual and prepayment we have. So all adjustments, yes, accrual and prepayments, how we can, and which statement, all been summarized here. Okay, next we have types of errors. Error of original entry, maybe we missed. Reversal entries, maybe we put other way around. Principal expense and the asset goes debit side, but maybe we put it other way around. That's the principally wrong. We can't say the cost motor vehicle is expense. Motor vehicle is the asset, not expense. But the people can under and number and the profit, they can manipulate it. Sometimes it's very creative. Huh? So we need to be look around those, and that can be error of principal, error of commission. Yes, wrong account, wrong person. Maybe we receive other wrong had, So that can be entry of duplicates can be account balance is incorrect. There can be errors. So these errors we need to make it adjustment. Error cause the difference in the debit and credit. Yes. In the trial balance, that's we need to make adjustment. Error of omissions, error of commissions, error of our subsidiary errors. Subsidiary errors mean the wrong person, but the trade receivable is the same figure, but we said I is supposed to receive Mr. A instead of Mr. B, so on. So that can be. Okay, error not deductible. Some errors is difficult to detect, because like error of commission, error of omission, error of principal, reversal errors. So errors not deductible in the trial balance. So we need to go back to invoices. We need to look around and then we can make adjustments. Okay, suspense account is the temporary accounts. Yes. So in the past we did that transaction. Maybe we not double entry. We record properly. That can be our one-sided. So we can create, suspense account and we can make adjustments. And especially in stage and things as well, carry on happening. Okay. These are all relevant links where we can look around different companies' financial statement like Morrison, Tesco, Asda with adjustments. So that also help us to when we prepare our assignment. Okay. Then all the relevant source there. So please, when we'll go through the cash flow statement, so we can look around cash flow chapter. So 6.6.2. So go chapter 6, please. And you can look around the cash flow statements. So thus we need to prepare to meet the criteria. Here we've been given here. Prepare the cash flow, operating, financing, and investing all activities. And so what we can look around, this question number is 6.4. So you go now 6.4. So here is the 6.4. So first we normally do operating activities first because operating means our normal business. Profit before tax. Depreciation is a non-cash expense which we minus first place, we adding back. Gain we put it as a profit. Now we minus finance cost is there, should we minus first place we add it and we minus again here, and then tax paid. Yes, so we need to be look around net cash from operating. Normally it's some positive cash flow. Normally if it's a negative, it's really we need to be look around, we are struggling then cash. So that's there, and then we can start investing. If it's addition in the non-current asset, it means we have more purchases of the non-current asset. Proceed will increase our cash flow. If we had financing, if our shares values increase, more shares and dividends. So all we need to be look around. And so on. So we can look around net increase and decrease. Yes, all the virtues, and that's help, when we prepare our. So these we can add, example to address our learning outcome, which is 2.3. Okay. Other than that, of course, again we can look around this link. Within that link, we've been given the cash flow question to test our understanding how much we know about the cash flow. We will see the same. We'll carry on further and we will find the question again. Yes, so you will see here carrying value, fair value, which we discuss IS which is adjustments. So you can pick it. Yes, gain on this is the cash flow. Yes, which side will goes, and then you will see here the question will be asked. Calculate the percentages. Okay, so these are all also help us to prepare the statement. Any question?
No, it's fine.
Okay, so next lesson we'll go through LO3. Then I created a quiz because only we are one person, so really not playing it. But we, you can do through links, which is, and I included here the question. You can look around the cash flow. Okay, so these handouts will be available on Moodle, and we can go through. Okay, guys, thanks for listening and attending today's session. So today's session we discuss about LO2, we discuss about financial statements, types of error, and adjustment, how we can make it. If you still anybody any question, please drop me email, and I'll try my best to get back to you as soon as possible. Thank you. Have a nice time, and I hope so. I'll speak to you during our next lesson. Thank you. Bye bye.
Thank you. Mr. Anzam, I need to talk to you just